Tesla stock is currently trading in pre-market action at $314.28, reflecting a gain of $5.43, or roughly 1.76% from its previous official session closing price of $308.85. The broader market has spent the past several sessions trying to calibrate where this EV powerhouse belongs, given that the stock has swung aggressively between its 52-week high of $498.83 and its recent 52-week low near $297.38. Most retail traders watching their screens today assume this slight upward bump is just a standard technical bounce after a multi-week sell-off, but the real narrative unfolding beneath the surface tells a completely different story. While the consensus view suggests that Tesla is simply battling softening global EV delivery numbers and margin compression, institutional order flow indicates a massive structural repositioning is taking place. Big funds aren't just trading car deliveries anymore. They are pricing in a dramatic shift toward autonomous fleet economics, energy storage scale, and proprietary compute infrastructure that could redefine the entire valuation framework. Every time Tesla stock experiences a sharp drawdown, retail sentiment quickly sours, with retail message boards claiming the growth story is dead. The common belief across Wall Street mainstream commentary is that auto manufacturing margins will continuously compress until Tesla looks like a traditional legacy carmaker. But that expectation completely misses the reality of how software licensing, full self-driving network deployment, and Megapack battery deployments alter cash flow generation. The expectation is a slowing industrial company struggling with EV adoption hurdles, but the reality is an industrial tech hybrid pivoting into high-margin platform recurring revenues. When you analyze trading activity across major retail venues like Robinhood stock trading or active accounts on SoFi Invest, you see retail investors reacting emotionally to short-term news cycles. Meanwhile, institutional desks using interactive brokers trading platforms are quietly accumulating positions during periods of extreme volatility. Look at the recent price action to understand where the tension lies. Over the past month, Tesla stock faced intense downward pressure, breaking down from levels near $400 all the way into the low $300. Daily trading volume spiked well above average during key breakdown days, signaling heavy institutional distribution from funds needing to rebalance portfolio risk. Earnings reactions were equally sharp, as operating margins reflected price adjustments across key international markets. Yet, despite this intense pressure, buyers stepped in aggressively near the psychological $300 support zone. Options flow data showed a massive surge in call option sweep purchases at out-of-the-money strike prices, indicating that sophisticated traders were positioning for a rapid relief rally. Sector momentum within consumer discretionary and tech growth has been spotty, but Tesla stock consistently acts as a liquidity sponge, drawing capital whenever market participants seek high beta exposure. Comment below how many shares of Tesla stock you currently hold in your portfolio and what average purchase price you managed to lock in. To truly evaluate whether current prices represent value or a value trap, we must peel back the layers of what this enterprise actually does beyond building electric sedans. Tesla operates through two core segments: automotive and energy generation and storage. On the automotive side, the revenue model relies on high-volume manufacturing of Model 3, Model Y, Cybertruck, and premium vehicles, paired with direct-to-consumer sales that bypass traditional dealership markups. However, as EV penetration reached higher levels globally, pricing power shifted. Legacy automakers launched competing models, forcing Tesla to adjust pricing to protect volume. This strategic choice protected volume and scale, but temporarily pinched gross margins, triggering alarm bells among short-term equity analysts. Beyond the sheet metal, the business model includes software monetization, regulatory credit sales, and energy storage systems. Energy storage, driven by industrial Megapack installations for utility grids, has grown into a major profit contributor with expanding gross margins that counter auto volatility. Additionally, the supercharger network has established itself as the default charging standard across North America, creating a steady stream of high-margin infrastructure income from non-Tesla drivers. Past financial reports demonstrate that whenever auto margins face pressure, energy storage and service revenues step up to support overall EBITDA, a dynamic that short sellers frequently overlook when focusing solely on quarterly auto delivery statistics. When retail traders check their accounts on the Robinhood app, SoFi Active Investing, or Schwab Intelligent Portfolios, they often compare Tesla stock against mega-cap tech giants like Apple stock or Nvidia stock. Unlike pure-play software businesses, Tesla carries significant physical capital expenditure requirements, supply chain logistics, and commodity price exposure. Yet, unlike traditional automakers, it operates without union labor constraints, possesses vertically integrated software architectures, and controls its own manufacturing automation designs. This unique hybrid structure is why valuation multiples like price to earnings remain elevated compared to legacy auto, reflecting market expectations of future software-like margin expansion through autonomous robotaxi fleets and artificial intelligence training clusters. For self-investing enthusiasts managing portfolios through Fidelity mutual funds, Fidelity ETFs, or direct trading via a Fidelity brokerage account, calculating risk exposure to Tesla stock requires understanding upcoming catalysts. The primary catalyst on the horizon revolves around the commercial rollout of unsupervised full self-driving and the deployment of dedicated robotaxi vehicles. If regulatory approvals align and the technology achieves human-level safety metrics across key states, the revenue model shifts from a one-time hardware sale to recurring high-margin ride-hailing fees. Conversely, if regulatory hurdles delay deployment or if hardware costs rise due to advanced sensor requirements, the transition could take significantly longer than bullish investors anticipate, keeping the stock range-bound. Macroeconomic pressures also play an influential role in short-term trading dynamics. High interest rates directly impact automotive affordability by increasing monthly loan payments for consumers. When interest rates remain elevated, prospective buyers delay major vehicle purchases, forcing auto manufacturers to offer financing incentives or direct price discounts. This macroeconomic drag has been a primary driver behind recent earnings misses across the EV sector. Furthermore, global trade dynamics, tariff adjustments, and localized battery materials sourcing requirements continuously alter production costs across Tesla's global gigafactories in Shanghai, Berlin, Austin, and Fremont. When evaluating online investment platforms for trading Tesla stock, sophisticated market participants utilize institutional toolsets to track order book depth and dark pool prints. Whether executing orders through interactive brokers' fee structures or leveraging SoFi stocks and SoFi robo-advisor algorithms, observing where big money moves during earnings announcements is critical. Recent institutional filings reveal a split sentiment. Traditional value-oriented funds have trimmed holdings due to valuation concerns, while growth-focused tech funds and thematic ETFs have absorbed those shares, viewing recent dips as rare accumulation windows for long-term artificial intelligence exposure. The tension between expectation and reality will continue to define Tesla stock performance over the coming quarters. Market consensus expects slow, incremental improvements in automotive sales and persistent pressure on profit margins. However, if reality delivers accelerated energy storage deployment, successful software licensing deals with rival automakers, or tangible progress in autonomous fleet commercialization, the market will be forced to rapidly reprice the equity higher. On the flip side, if production bottlenecks, execution delays, or competitive pressures in key Asian markets intensify, the stock could easily test lower support levels before finding a sustainable floor. Investors navigating self-investing strategies through an individual brokerage, Fidelity Wealth Management Solutions, or SoFi trading platform options must remain disciplined. Relying solely on headline news or social media hype often leads to buying at local tops and panic selling at local bottoms. Tracking concrete metrics like quarterly automotive gross margin excluding regulatory credits, Megapack gigawatt-hour deployments, cash flow generation, and software retention rates provides a far clearer picture of corporate health than price charts alone. In summary, Tesla stock remains one of the most polarizing assets in modern financial markets. Today's pre-market movement to $314.28 highlights an ongoing tug-of-war between short-term macro headwinds and long-term tech option value. While the popular narrative focuses on vehicle delivery numbers and temporary margin headwinds, the underlying shift toward energy storage scale and autonomous platform monetization represents the real core of the investment thesis. By contrasting popular market expectations against operational realities, investors can cut through the noise, manage risk effectively across their trading platforms, and make informed decisions based on fundamental progress rather than daily sentiment swings. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.